Ladies and gentlemen, shut up! Thank you. If you don't mind, we are running a bit late, so I want to get on with the rest of the evening. We have quite an exciting panel session coming up. I'm going to introduce the guests to you. They're the same three that we had here last year, so you can call them to task for what they said last year and what's happened over the year. They've all three of them had what I think are really exciting years. They've all achieved a lot, and I think it shows what can be done by perseverance, patience, and good management in this market. So I'm going to give them a chance right up front to just explain what they've done in the last 12 months and some of their developments, and I think you'll find it quite exciting. Now, just as I said last year, I know a number of you were here, and we had the same panel guests. And then I asked them, okay, what about M&A? How do you see that going? What will bring back investors? What's the role of private equity? Are you seeing private equity playing a role at the moment? What are your cost-cutting initiatives? And what are the challenges for the industry? To be quite honest, a number of those questions are still relevant. Last year at this time, the gold price was $12.98. It's $100 down. It's $11.95 at the moment. The Philadelphia Gold and Silver Exchange, the index of gold and silver producers, was 91, and today, or yesterday, it was 69. So it's down 50%. So I think that puts things into context. So those questions I asked last year are still pretty relevant, so I should be asking some of those in a slightly different way when we bring our guests up. So I'm going to do ladies first, if you don't mind, Bruce and Sean. So our first guest is Diane Garrett, who's Chief Executive of Rimarco Minerals, who are now, I'm happy to say, building a mine in the Americas, and after, as I said, taking a lot of patience and perseverance. But will you please welcome Diane Garrett?
Thank you. In the middle? Oh, here.
And then the Chief Executive of Agnico Eagle Mines. Again, they've had quite a spectacular year, and they joined the top 10 gold producers in the world, I think. And so will you please welcome Sean Boyd? And then last but not least, the man who said to me, I've got an answer for all your questions today, higher gold price. The Chief Executive of Timmins Gold have had a great year themselves, record production, and just about to finalize a new acquisition, Bruce Braganola. Thank you, Bruce. Sorry? Oh. Diane's having a wardrobe malfunction. Unfortunately,
you don't have this problem.
It's just a necklace, unfortunately. It's not a... Still.
Oh, well.
All right. Now, as I said, I'd like to give you... You've all had great years, I think. So spend 5 minutes each explaining what's happened in the last year and your major developments and basically why you did these things. Well, you've been on a path for some time now, so would you like to start and just explain that you've had some great milestones in the last year, haven't you?
We've had fantastic milestones. We have our Hale Gold Mine in South Carolina fully permitted and fully financed. And now we're starting construction, and we'll be one of the lowest cost and highest grade open pit gold mines in the industry. And we are the first company to bring gold mining back to the state of South Carolina that started all gold production in the U.S., first gold mine in 25 years. And we defeated the odds of everybody that said there was no gold there, and then you can't permit, and then you'll never finance. So it's been a great year for us, and we're looking forward to becoming a new producer in the space.
Is that it?
Would you like me to go on?
Last year, you name-dropped at every opportunity. Now I've given you a great opportunity, and you limited yourself to a minute. Well done.
Thank you.
Sean, you've had a particularly spectacular year. You've been very active, and your gold production is up and everything. Just explain some of the events in the past year.
Yeah, it's been busy. But first I'd like to thank Ingmar Hagas here. He's our Vice President of Europe. And he's been responsible for building our business in Finland, which you saw here. And I think that's a great example. That's the biggest mine in the European Union, gold mine. And there's many decades of production there. And I think that shows you what can be done and how a mine can coexist very close to a major tourism area. And we were sort of blown away when we first got there. And the mayor of the municipality, who unfortunately passed away a couple of months ago, was basically saying, when are you going to get this built? It wasn't, okay, what are you guys going to do? It's, we want this mine there. And there's not too many places like that in the world. And in fact, what they don't say on that video, and the government officials don't say, is the corporate tax rate in Finland is 20%. So it's viewed as a higher tax or a jurisdiction. It's now ranked the #1 mining jurisdiction in the world by the Fraser Institute, a think tank in Vancouver, which does the measure by way of mineral policy and mineral potential. So we're certainly happy to be there as one of our sort of anchors and foundations. It's a great place to be. But in terms of last year, we sort of continued on that track that we set back in late 2011 when we had some challenges. We recast the mine plan at Meadowbank. We had another record year of production coming out of all of the mines. They were all contributing to that success. But of note, as many of you know, we were active in the M&A field. We, with our partner Yamana, were able to purchase Osisko, and I know the Osisko team is here. And we just find that that's been a great acquisition, a welcome addition to the family. It happened to be in an area that we would consider our backyard, so we're proud to be owners of that. And we've said many times, the mine was well built. It works extremely well, and the team was very efficient. And everybody asks us, how's that partnership going with Yamana? Because we do have some different styles. And it's going very well, because the mine was built well, it works well, and the team's a solid team. So that brought another long life asset to our story. We also did another transaction in Mexico, and we're sitting beside the Mexican ambassador to Switzerland, and we often talk about our business. And our Mexican business looks almost like the Finnish business in terms of its 1,600 people, Mexicans, running a Mexican business. And that's been our model. And we decided to expand our footprint there and did another acquisition late in the year. So those add to our foundation, add to the quality of the business. But in my 30 years at Agnico, the guy that sort of has been behind the scenes driving a lot of our sort of new initiatives and allocating capital is also here, Elaine Blackburn, our Senior VP Exploration. He doesn't get a lot of credit. But I first met him at LaRonde when it was 1.5 million ounces, and we stood on something on surface. He said, this is significant. Well, lo and behold, there was 9 million ounces. So he's the gentleman that said, buy Pinos Altos. He was the gentleman that said, buy Kittilä. He said, it's going to be big. And he made what we think is a significant discovery in Nunavut. And he's here, and he's showing off some core here. So when he gets excited and his team get excited, I get excited. So I would rank that as our #1 achievement for 2014.
Bruce, you've had a record production, and when's your acquisition closing?
The vote's on the 29th of April.
Right, okay. Would you just like to tell the audience about what you've done the last year since we were
Sure,
here?
it's been a very busy year for us as well. It's funny how we're all kind of connected in some way. We started off the year after the Denver Gold Show in Zurich last year by adding 5 new directors to our board of directors. And the Osisko transaction actually freed up 2 very qualified people for us, 2 of whom are here today. It's Luc Lessard from Osisko, who is here. Thank you, Luc. And Brian Coates, our chairman. Thank you, Brian. They've been wonderful additions to our board. We have a very well qualified and very attentive board of directors, and it's been very good to work with them. And after bringing on the new board, it gave us kind of a new mandate with the company to grow the company. And we looked around, and the production was going very well. Our costs were coming down. And this was in the face of declining grade at the mine. Our plan was always to keep the grade coming down to the level it's at now, but also to decrease our costs. We were successful in decreasing our costs by 25% to offset the decrease in the grade. So that was a big challenge for us this year. We met that. And then we bought an asset in Mexico. We think it's a very good acquisition for the company. It's called the Caballo Blanco open pit heap leach project in Veracruz. It's about 1 million ounces, and it's going to be a nice mine for us in the future. And with our Mexican team, we have 500 people working at the mine directly. We have probably a core of 10 key employees, key management people that work with us. So we're an integrated team. We're the Canadian financial/regulatory arm, but the real operations take place in Mexico, and we've got a great team there. And on top of that, we're in the middle of a transaction right now to acquire all the shares of New Strike Capital by way of a plan of arrangement, and the vote for that is going to be held on the 29th of April. So it's been a very, and this might play into the theme of the evening. You can see, some of the difficulties encountered when you go through a transaction. You can see, well, the acquisition of Caballo Blanco was an acquisition that was done by way of an asset purchase. It went very quickly and it was very clean because it wasn't subject to the vagaries of the market like our corporate transaction is currently. So this will play into the theme of the evening as we go forward. So yeah, it's been a great year, and lots of work to do going forward on a fundamental, let's put the mines in operation basis.
Thanks. I'm going to push on with a number of other questions, but please, if you want to interrupt and ask a question in the middle of this, or you've got a burning question you want to ask, please put your hand up and we'll try and address it, because as I said, I'd like to make this as open and audience participation as much as possible. You've got a great chance to ask these guys some testing questions. We talked about a little bit about exploration, certainly about acquisition from what we just heard. Sort of historically, there's two models of growing a company: exploration or acquisition. Obviously, in practice, there's a combination of the two. But some companies are clearly focused on exploration. Some companies are clearly focused on acquisition. Given the market values of a lot of projects and a lot of companies now, it seems like a great opportunity to acquire. And by doing that, also, if you cut your exploration, you're cutting your costs, and you're all in sustaining costs. You might be jeopardizing longer life, but there seems to be this fairly compelling argument to actually acquire rather than explore at the moment. So I'd just like each of you to address that issue and perhaps relate it back to your own experiences, particularly in the last year. Can I start on the other end now with Bruce?
Sure. I think you're better off buying ounces these days than drilling them. You have the certainty of the existing resource reserve. You know what the cost of those ounces has been. So I think you have a greater degree of certainty buying ounces right now rather than exploring for them.
Sean, no junior in Mexico seems safe. You're probably going to be knocking on their door. Perhaps they're probably delighted, actually, but so you've made some acquisitions in this now, but of quite often early stage stuff. So.
Yeah, we use both techniques, and I think it works well for us because we like to go as early as we can, because we take our lead from Elaine Blackburn and his team, who've worked with us for 25 years. So for us to sort of say we want to own something, we need the corporate development guys and the project evaluation guys to do their normal work and generally say there's no fatal flaws and this makes good sense. You need the operating guys to say, yes, we can turn this into a meaningful part of our business, and here's how we think it'll look. But for me to actually say, yeah, this is something we want to own, we need Elaine Blackburn and his team to say, it's this big now, but we think it can get this big, and here's how we do it. So we use a combination. And if you actually look, since 2005, when we went from a very regional-focused Quebec-based miner to now 9 mines and international, we've done, I think, 7 deals. But we've never bet the farm on any single deal. And we always made sure that we had that upside. And I would say comfortably now that we're probably the only producer that's doubling its exploration budget this year. And it's not because we want to just spend some money. It's because we actually have good targets. And it's not just the new discovery in Nunavut. It's also deep drilling at Finland, where we need to add another drill. It's in Mexico now, where we've got a program for $15 million at Barqueño that was acquired with Caden. So we like to get on early and then get those drills turning, but really to use the expertise of our team, which has that demonstrated track record.
What's your drilling budget or your exploration budget this year? Then you say you're doubling.
It went from about 60 million last year. It'll probably be 110 to 120 million. But in that number, we only have 20 million allocated to the Amaruq discovery. We can actually physically spend 50 or 60 million. We have capacity for 10 drills. We'll have 8 drills turning by the end of this month. We'll probably have that 20 million spent by early June, and the drill season lasts to October. So I would fully expect that they're coming knocking on the door and asking for more money. Last year's budget was $1.5 million. They spent 10. So we dole it out based on results, and that actually what I said to Elaine, I said, boy, you work a lot better when I cut your budget, which was last year. So, you know, you're going to have to work hard to get more money, which he's done. He's got the results.
And presumably it's easier to get drills on the ground these days. It's less demand. And
less demand, but what you get with that, and we actually think now is the best time to drill and best time to build and best time to be looking for stuff, because a lot of guys are going the other way. What you're getting now from a drilling contractor is extremely competitive prices, but the productivity hasn't been this good in years. So not only are you getting their best equipment, you're getting their best drillers, because a lot of the drillers that were sort of on the fridges are gone now. And so that's what we found when we were drilling in Nunavut last year. Our cost to drill a meter in Nunavut is less than $300. It's cheaper for us to drill in Nunavut than it is in Mexico right now. And so, you know, that's a testament to the way we set up the logistics. So for us, it just makes sense because we're adding ounces. That's the best way we can create value right now.
What is the discovery cost per ounce today?
Well, in Nunavut, it's quite cheap because we spent 10 million last year. We have a resource of 1.5 million ounces. As we tighten up drill spacing, which we can do with the first $20 million, there's the potential to grow that 60 to 70% based on the structure. We've only drilled a kilometer of what is a 12-kilometer geophysical footprint. So here's another point, and it's not just the geology that we're excited about. I think this industry is really struggling to find parts of the world where you've got that rare combination of mineral potential and the ability to do business. Nunavut is becoming that place. It looks a bit daunting when you look at where it is and the logistics, but there's actually a way to manage your costs there. So we love the mineral potential, and we think that we're going to find a lot more gold there and be able to, you know, turn it into a significant part of our business.
That was a question I was going to ask a bit later, but maybe it's the right time to ask it now. One constraint is possibly having manpower and the skilled manpower in the industry at the moment. Are you seeing that? Can you get the right geologist?
Geologists aren't really a challenge. I think where there's a bit more of a challenge, at least for us, is mining engineers. And we have a pretty broad range of skills. We do a lot of this in-house rather than use consultants to build our projects. But, you know, we're actually hiring people right now, which is not happening a lot in the industry. But the key people we're looking for is actually top quality mining engineers.
Diane, you're obviously focused on one thing, and that's building a mine at the moment. But once that's bedded down, commissioned, and in production, you have a big property there. So
Exactly.
Presumably that's going to be your focus thereafter, is to fully explore the rest of your property?
Correct, and we're actually not going to wait until we become a producer. We, at Hale, which is pushing 5 million ounces, we idled our drill rigs 2 years ago to conserve our cash to get through the final permitting stage. But Hale is an enormous property. There are hundreds and hundreds of historic gold mines in the southeast, and many within the state of North and South Carolina. And we're pretty good at what we do, but we're not that good to find the only 5 million ounce deposit the first time out. So we've taken our interpretation, which is different from anybody who's operated in this area, and all of the majors were exploring this area in the 1980s. We have reinterpreted that geology, we've applied what we know, and we have a world-class ore body with Hale. So while we idled our drill rigs, and we own 5 of our own rigs, We sent our geology team, a team of 8, into the field for the past 2 years, and they have taken data and information on 50 different historic mining areas. Most mined in the 1900s. In the 80s, heavily explored by the majors, Homestake, Newmont, Barrick, Westmont Mining, Kennecott, and what we saw at that time, which is the same thing we applied at Hale, is everybody in the 80s was looking for oxide heap leach material, where the oxides in this area are very, very shallow. And as they drilled through the oxides and got into the pyrite ore, it's sulfides, they said, well, game over, we're not going to heap leach that and have any significant recoveries. But as is so true in our business, technology has changed. We now have fine grinding technology, thanks to the Australians, which is practically old technology today. And reinterpreting the geology and then applying the new technology, we can do very well there. And we have taken 50 historic mines, all the drill data, we've gotten access to the properties, we've taken samples, we have our own fully accredited assay lab, the only one of its kind on the east coast of the United States. And we have been doing all of our field work the past 2 years. We now have a list of 12 projects that we are in the process of acquiring. We will move our rigs as soon as they finish drilling the dewatering wells for the first pit that we're going to open. We'll be moving those rigs back out onto the district. We truly believe this is an underexplored area, much like Nevada was in the early 1980s. And, you know, we have a saying in the mining business that the best place to find a gold mine is next to another one, and we just believe that there's a lot of opportunity. Some have historic resources on them, much like Hale. So we're not going to waste any time in moving our rigs out there. The benefit also of having our assay lab already built is not only will it be a legacy for the community, but when we're drilling, we can very quickly in 24 hours know if we're in waste or we're in ore. So we don't have to send the waste holes to the lab and spend that money. And we go where the geology takes us, so we can very quickly know where we are and plan the next step out holes. Now, as a cautionary note to everybody in the audience, when we release our assay results, they are all done by a third-party independent lab, but it helps expedite our work. And to your comment about exploration versus acquisition, I mean, I don't think the two have to be mutually exclusive. I think you can have a combination of the two. On the one hand, looking at the industry, I think there has to be more consolidation in the industry. I think it only is going to yield a much healthier industry. For us, it makes more sense to drill in our own backyard. Our discovery costs are less than $20 an ounce, and our drilling costs are $100 a meter all in, assays and everything. So for us, it makes more sense. And when we know that we've got this much potential out there regionally, we think this is the right way to go, but we also keep our eye out also for acquisition opportunities. But I think it's a function of what's the better value for your dollar.
Yeah, okay. And just as a quick aside, are you fully permitted on the rest of your property to explore? You don't need to have any other permits?
Permitting is very interesting because we're on private land. We own surface minerals and water. So for us to permit a drill site of as many holes as we want in area, it's about 2 weeks. The only thing we need is a stormwater permit because we do get a lot of rainfall in South Carolina, and we have to make sure our retention ponds are sufficient, and that is generated through a stormwater permit. But 2 weeks, we will have permits for drilling as many holes as we want in each of these properties.
Okay, thanks. Any other questions? Anybody got any questions on exploration, acquisition, comments or anything? Do we have them there, Patrick? Okay. Thanks.
Can I speak like this? Yep. Yeah. Well, thanks very much. Just a question. We see you looking for growth through acquisition, organic growth and everything. And at the other end of the spectrum, we see Barrick facing the daunting challenge to get rid of its properties because they feel they are too big and the market is not paying for its reserves. So is there an optimum level, or is growth for growth's sake the right strategy?
Is that addressed to any particular member or the whole panel?
Probably Sean would be the person that would be more...
Sure. We've been around for 58 years. One of the things that we were more focused on is not the ultimate size of our business, more on the manageability of the business and the sustainability of the business. And a lot of that relates to complexity, and the industry has become much more difficult and much more challenging. So we're at a size now that we have a very manageable business. We have 9 mines. But if you look at the distribution of those mines, 4 are in Quebec within 50 kilometers of each other. 3 are in Mexico within 70 kilometers of each other. So it's a business we can manage. So for us, it's not about a magic number. It's about, how many mines can we physically manage and how many mines do we need to continue to build the quality of our business. And so a lot of companies made a mistake because, as many of you know, the conventional wisdom 15 years ago was bigger was better because it was more liquid and hopefully more valuable. I think Agnico and others of our size have proven that wrong because we tended to stay on the smaller size. And after 58 years, we have 212 million shares outstanding. There are several companies in the billion share club outstanding. So we think the best approach is to be measured and make sure that what you take on, you can actually manage. And I think what the big guys have proven is they've built businesses that are now unmanageable. And now there's several companies that are forced to deconstruct their businesses before they can move forward. We're still fortunate that we can actually move forward from a base that's manageable right now. So that's just a good position to be in. So the faster you grow, the bigger your challenges are. And so we'll continue to sort of do that in a very measured fashion.
Any other comments? Thanks for that. Great question. Turning to the market now. Since we were here last year, the gold price is down $100. The XAU is down 50%. So we saw a bit of a false storm perhaps in January. But the investors seem to have been shy of the market again. So what do you think is happening out there? Is it because they see better opportunities elsewhere, or is there just a general lack of belief in gold? And following on from that, what do you think management yourselves can actually do to try and attract investors back to this market? And if there's any fund managers here who would like to add an observation or a comment, please feel free. Diane, can I start with you?
Sure. I think one of the big drawbacks to investing in gold right now is clearly this overly bullish view on the US dollar, which I think, well, coming from the United States, I think it's defying gravity and it has for some time and it needs to correct. And I think it may peak hopefully in the near term. And I think that's one of the biggest drivers. So it leads gold as a vehicle for maybe, a third or fourth rate investment opportunity. I think we need to see if the Feds are going to be continue to be a bit dovish on their decisions on interest rates to see what that will do for gold. But gold is a cyclical business, always has been, always will be. We are coming on into the last year of what historically has been one of the longest bear markets that we've seen in gold. And, we can talk a lot about China and we can talk a lot about demand and who's selling what, but at the end of the day, it's usually the competing investment vehicles that we see. And right now it is the dollar. And it's not that the dollar is so phenomenal, but it's the best of a lot of the currencies. It's the best of all the worst. So I think what it's going to take for gold is, look, I think corporations have a lot of responsibility in what's happened to the valuations, notwithstanding the gold price. It was, as Sean said, go big or go home, and it didn't pan out for the investors. There was over $280 billion lost in market caps in 2013 and $58 billion of write-downs. Those are staggering numbers. So we're going to have to see, for the shareholders to feel comfortable coming back in when gold prices turn around, they're going to go to those things that are managed well, where you have operational execution that's done right and management responsibility. And so management needs to take advantage of this time to cut costs, to optimize their own projects, and to really get back to returning value to the shareholders versus trying to return value through just growing bigger. But I do think, we're going to see better times in gold. I certainly hope so. I don't think we'd all be here if we didn't believe there were better times to come. But I think it's also going to take a significant correction in the US dollar and the confidence of getting the generalist funds back in. Every time we've seen a nice movement in gold, we see the generalist funds start to come in and then gold corrects significantly. So it's been very volatile, which also can be a very good indicator we're at the bottom. But also, the generalists are the ones that are really going to move the market, and they're going to have to see a sustained higher gold price.
Thank you. Sean?
I think the sentiment or the conventional wisdom is really around the Fed and the expectations that we're going to get an interest rate hike. And the question is that what is the level that it's going to be raised, and is that already built into the gold price? And And that's really affecting investors' views on the equities as well, because everything's lumped in the same basket. So while that's going on, there's still a number of businesses that are actually improving the quality of the businesses while we have this sort of low gold price, I think, which ultimately is a good thing, because things do change. Things never stay the same. We will get a turn in gold, and it's those companies that still have a business property position that are going to do well. But I think what we look at is, as we look to the future, is there's a lot of key drivers out there, and we sort of try to simplify the supply-demand side. And you've got 1,000 tons or so in China to 1,200. It can be a bit of a black box. India's sort of rebounded 900 to 1,000. Central banks have been 300 to 600 tons. That almost equals the mine supply. And so the swing factor has been the investor who hasn't been there for good reason. There are competing investments there, but those things do change. So there will be conditions where it is certainly more favorable. I think the sentiment here, I haven't seen it as negative here in a long while in a market that traditionally is friendly to gold. And I think that's a reflection of sort of just being worn down. But I think one of the positive things is we've seen gold over the last 3 years sort of fall back into the 1120, 1130 range, and it doesn't stay there that long. There is some buying there. And we just look at it and say, outside of the U.S., there's a big world out there. It's getting bigger. Populations are growing. Wealth is increasing. They have an affinity for gold, and they actually want it close to them. So ultimately, that's going to sort of win out, and that will have more of an impact on the price, we think.
Thanks, Bruce.
Well, I think everybody in this room is interested in gold to an extent perhaps not seen in the United States or in the generalist community. I mean, we're all in favor of gold and higher gold prices in this room. From my perspective, I look at it as we're in a very funny situation right now. If you look at the supply of money, M2 money supply, you look at the supply of debt around the world, gold right now should be at $2,400, just based on a historical following of those two monetary measures. So what we've seen, and it's something that we kind of forget about, is that the American markets were flat from 2000 to about 2010 when QE came in. And the QE money has backstopped the American stock markets, so they're flying along, and then all the liquidity is flooding into the US dollar and into the American stock market. Well, if you're an American stockbroker, which is the biggest market on the planet, and you tell your clients that, no, don't buy the rising Dow that went up 30% last year, put your money into the gold market, you're going to lose those clients very quickly. So I think we have to see more margin in the gold producers. We have to see a higher gold price for that. I think costs have come down dramatically in the last few years. So I really think we need to see more liquidity come into the market in gold. We need to see a reason, which means perhaps the other markets aren't doing as well as they are right now. And we need to get back to that correlation between money supply, debt supply, and the price of gold.
Sorry, go ahead.
Sorry, Pat.
Sorry, yep.
Hi guys, it's Sean Rosen here. Just wanted to say to Sean, thank you very much for the work that he did with us in 2014, and congratulate you on the success that Agnico has shown. But my question for everybody today is that I think that one of the things that gets lost in the translation here is that everybody thinks about the US dollar gold price, whereas if we look at almost every other currency in the world, gold is doing its job very well. And I think that in terms of having mines that are operating outside of the US dollar districts, the mines are actually looking and performing fairly well. So I just wonder if a few members of the panel just look at the expanding margins due to currency changes, and also the commodity suppression that we see in oil and gas, steel and the rest, that's going to be having an effect that maybe sets the stage for investors to come back into the gold mining space, and how that's affecting the operations, and maybe set the stage for a bit of a recovery in gold mining stocks.
Yeah, thanks, Sean. That's a good point. I was talking to an Australian producer today, and he said, well, we're getting $1,500 Australian for our gold at the moment. and yet the gold price might go down $10 in New York, and our share price goes down. People don't quite understand that in other currencies, gold is actually doing pretty well. Bruce, you touched on a point, because basically the discussion in the last 10 minutes has been focused around gold per se, but what about gold equities, your gold mining companies, gold explorers? What is the investment case for that? If I'm a generalist fund and you walk in and say you should buy my company shares, what is the investment case at the moment, do you think? Who'd like to take it off first? I'm looking at Bruce.
I'll start off, sure. Well, you look at, in Switzerland now, you have negative interest rates on deposits, which is uncanny. I never thought I'd see a time in my life when you had to pay the bank to keep your money. So you're much better off with a bar of gold in a safe deposit box that is going to appreciate in U.S. dollar terms. I mean, let's face it, the U.S. dollar has had an incredible run. It may go higher, it may not go higher, but certainly if you have a bar of gold, you have some protection against against a number of different things, including a complete bank meltdown at some point. So there's a number of different factors out there. You've got declining commodity prices in general. For example, it doesn't impact us as much in Mexico because the price of oil is already subsidized in Mexico. We have half of our costs in U.S. dollars. Our mining contractor is paid in U.S. dollars, but the rest of our costs are in pesos. So we benefit on one side, and we have a natural hedge, basically. So we benefit on one side and not the other. If you're solely in Canada, I'm sure that you're doing very well. But eventually, when you convert it back into U.S. dollars, it doesn't look quite as good. So it depends on a number of different factors, and you have to try to optimize each one to your advantage to keep your costs down, for one thing, and to make sure you're making more money. But really, we need to see some increase in the price of gold in U.S. dollars, which might mean we need a weaker dollar to make the price of gold look better in all currencies in that case. Now, I don't know what's going to happen in other currencies in that case. Maybe those will go up at that point.
Sean, I'm an investor. Why should I buy your stock and not a bar of gold?
Well, it's certainly an opportunity, I think, to look at the industry. And I think the industry's done an effective job of recalibrating their reserves using lower prices. That's what drives mine plans. So it's really about timing, though, at the end of the day. And if we're in an extended trough and it goes another year or 18 months, from an investor point of view, you're still looking at companies that have a solid business that can actually sort of weather that storm. And Sean Roosen made a good point. The impact of currencies is actually extremely dramatic. We did our budgets a year ago for 2015, and the budget assumption on the euro was 8.80. It's now over 1,100. Our budget assumption on the Canadian dollar price was 12.50. It's now 1,500. So the impact is quite dramatic. So there are actually two parts to that, and it impacts the timing. Certainly there's an opportunity to get in now. The question is, how long do you have to wait for the turn? But ultimately, it does turn. And the question that you would have is the company you invested in a position to deliver the margin? There are a number of companies that have made the changes necessary to deliver on the margin. The margin was crushed in the past because we were basically increasing the gold price for the reserves. So the reserves were going up in size, but the quality wasn't. So the reserve statement goes to the mine manager every year, and he's told in that run-up, oh, good news, your reserves are up 8%. And the guy opens that up and looks at the details. My grade's gone down. I can't meet my targets. So the question going forward are the companies' mindset changed to the point that they're going to resist that temptation to readjust mine plans in a rising gold price environment? Because if we do that, then the margin's gone again. So I think the industry has really learned its lesson, in my sense. Not everybody, but I think there are companies that are sort of getting that. And we also had the complicating factor back in 07, 08, where not only the gold mining industry, but the other extractive industries were going at such a pace, it was putting tremendous pressure on inputs. We don't have that pressure on inputs. And in fact, that's a good environment now. So if we can maintain the right pace that doesn't put input price pressure and then resist the temptation to allow the explorationists to increase the size of the resource and reserve just because gold price goes up, we can deliver that margin. And that's the opportunity, I think.
Diane?
Absolutely agree with what Sean said, so just ditto on that. I think that, in addition to that, it is going to be very prudent on companies to manage what they do in terms of their reserves. We did our reserves at 950, and we're not going to be much higher than that when we complete a new reserve, because it's important. Are your reserves going up as a function of just raising your gold price? And as Sean said, the quality of those ounces go down. Or are you, actually finding ounces that have a very good quality as well? So I think for investors to come back in, they should be looking at those companies that have had a very prudent, measured approach to the way they conduct their business. I think Agnico Eagle is one of the best examples out there, but for full disclosure, I am a shareholder of Agnico Eagle, so I just want to fully disclose my conflict there. But that's the kind of thing people have to look for, and I think when the generalists came in, and they immediately think, well, I'll just go to the large and liquids and I'll buy the Barricks and the Newmonts, and when they can't even make money in those because they don't know the mining business very well, then they throw up their hands and say, well, my gosh, how can I really generate any significant returns? So, with a junior company or a mid-tier. So looking at those companies that have had a very prudent, managed approach and a very responsible approach to their execution is going to be important. As a former fund manager, we know that everybody should have 10 or 15% of your portfolio invested in gold. It is the anti-dollar. It helps in diversification. And when you have volatility in other markets, it does help offset some of that volatility. And what you want to do is be able to invest in those companies. The reason you want to invest in equities over bullion, although I think bullion's a nice thing to have as well, is because the leverage that you get on investing in an equity is far in excess just the price that you would get on the incremental increase in the gold price. So I think the managements that have proven their track record and have been able to manage in difficult environments and staying within that mindset that as the next bull market comes, and we know it will, still being able to manage in a prudent way, and I think that's what's going to help drive investment to those vehicles back.
Thanks. We have a question at the back, I believe. Is that right? Somewhere there. Roger, is that you?
Hello?
Got shy.
It seems like last year all three panelists had a great year. Bruce, I congratulate you. You had a great acquisition year. You picked up some juniors for pennies on the dollar. And Sean had a good year with lots of drilling, being able to get the drillers for cheap. And Diane, my hat is off to you. We believed in you, but we were not sure that you were going to be able to pull this off. You got the permit, you got the investments. Congratulations. My question is for all of you three. What do you guys think as an industry, as individual companies, yourself, what you have running with your company, as a next challenge for this upcoming year? Like next big challenge, what do you see in the industry and for your own company?
Good question. I was about to ask that one myself. So who'd like to pick it up? Don't be shy. Bruce?
Yeah, sure. Well, for us, with 2 acquisitions under our belt, one done and one coming up, we have to consolidate what we have. It's been very busy. It'll be 2 acquisitions in 4 months, so that's a pretty good track record, I guess, for moving quickly. So now we have to assess the social, economic climate. We have to apply for permits. We have a lot of work to do on the ground. We have a lot of team building to do. We have to add people that are qualified. We're lucky in Mexico right now. There's a lot of skilled manpower available out there, and woman power. And we have to go into the communities. We have to make sure that we become engaged with the communities and get proper stakeholder approval from all of the stakeholders in the towns in which we'll be operating. We have to redo some metallurgical work. We have to assess all of the intricacies of permitting, development, of building in the future. So we've got a lot of technical work ahead of us over the course of the next year. It's normal work. It's normal, social contract work, but it's something that we take very seriously, and it's something that we plan to advance very quickly on. For example, at Caballo Blanco, we've already engaged with the local stakeholders. We've had a social worker out in the villages looking at the needs of the villages. At San Francisco, we've got a great track record of working with the communities to provide them with the things that they need. This new tax in Mexico, we all didn't like it, but it looks like it is going to be properly applied, and the half of the 7.5% new tax that came in 2 years ago, it looks like it will be properly administered to provide good tangible benefits and infrastructure to the communities in which mining takes place. So we feel that there is some positive change happening, and that we will find that we do get buy-in from the local people to give us that social license to operate.
Okay, Sean.
Well, for us, we've got a net free cash flow generating business, and it's not done at the expense of squeezing projects or cutting exploration. And there's a number of initiatives we have ongoing at the mines to optimize those mines. So that's clearly a focus. But day to day, my job is really to allocate capital and develop people. So we continue to work hard at those two things. But I would sort of say it's not really a challenge, more of an opportunity. And that opportunity has really become more apparent in the last year, and that's in Nunavut. So we've got a number of moving pieces in Nunavut with Meliadine, Meadowbank extending the life, the discovery at Amaruq. It's how do we fit those pieces together, because it's early, it's very early, but it seems to us, based on our experience, or our people's experience, that it's got the makings of something special that could become a significant part of our business. So it's how to put them together. And we announced some changes recently in personnel, and we had a number of engineers working on those separate components. But it was clear to us that we needed a leader to sort of take all those parts and create a vision and put it together. And we appointed a young metallurgist who's done a lot of good work for us. He used to actually be the general manager at Meadowbank. We've brought him back to Nunavut. He's our VP Nunavut. And so we're working closely with him to create that vision and see how those parts fit together. So that's a big effort. It involves our technical service group, our business strategy group, our exploration team, our northern business operating guys. But, he's got the leadership talent, and that's part of our leadership development. Those are the type of guys that ultimately will drive this business going forward. So that's what we're paying a lot of attention and focus on.
Thanks, Sean. Diane?
Well, I think the challenge always at this stage of development when you go into construction is maintaining schedule and maintaining budget. And if you don't maintain schedule, you certainly will not maintain your budget. And some of the things that we've done to mitigate that is we're different from a lot of developers in that we brought our entire operating team on 4 years ago, 15 department managers, hand-selected. They came all from senior gold producers, predominantly Freeport, McMoran, and Barrick. These individuals have not worked together as a team building a project, but they have built many, many projects in the industry and much, much larger than we're building at Hale. The benefit of bringing them on early is because they have learned to work together. They've designed this project, and they've been vetting it through feasibility, optimizing mine plans, supporting all of the permitting activity. We've had the mining and the milling department housed together for the good part of 1 year just to be familiar with each other of what needs to be delivered and the form it needs to be delivered in and how. You don't ever want to get into a situation where you start up an operation and the mill guy goes, "Don't look at me because I didn't design it. I wouldn't have designed it that way, so this is not my problem." Well, these guys did design it this way. We've had it vetted by 2 different independent engineering firms, and this team is ready to go together. The other thing we've done is we are 88% through the detailed engineering. And for those of you who may not be familiar, most projects start construction when you're somewhere at 35 to 45% through detailed engineering. We're 88% of the way through. Often what happens is your construction starts at such an aggressive pace and it can outpace the engineering activities, and that's where you can get into trouble. We're not going to have that issue here because we're so far advanced in the detailed engineering. And by having this team and being that far advanced, it's why our capital costs have not changed more than 10% since 2010, so almost 5 years now. And you haven't seen that much in the industry with all the capital cost blowouts, and 8% of that 10% was scope changes that we actually actually implement it into the design. We have the benefit of keeping our team in the engineers' offices and making sure that we are managing that process with them. But staying on schedule, staying on budget is going to be the key for us this year.
Great. Thanks for that question.
Thank you very much. But I had actually a second part to my question, which was the industry as a whole. Do you see any, foresee any challenges that's upcoming for the next year?
I think it's an ongoing challenge to find quality deposits in parts of the world that you can actually do business, as we said earlier. And I think that's the ultimate challenge for this industry. A lot of the easy deposits were found and mined out in the 80s and 90s, and it's becoming increasingly difficult to find those opportunities. They're out there. You just have to be patient and think long term. So that's an ongoing challenge that the industry is facing right now.
I'd agree.
Okay. We're running a little bit short, so I think we have one more question at the back there. Is that right?
Yeah, one more question from table 20. Sorry to be the trouble table. I think that it's pretty clear that the macro picture is less than perfect now, especially with the dollar issues and various currency issues. We have a view that probably gold is going to continue to slide, which is probably not so great for some of the investors that got in a bit early. But should that slide continue, my question is how can you use the falling price to your current advantage for your various operations?
Right.
Falling.
Well, I think from our perspective, I think we've already taken advantage of a falling gold price. When we look at the quality of assets available, the assets that we bought in the last 4 months, so one we bought and one we're in the process of acquiring, they're both lower cost operations than the current operation. So we're trying to take advantage of the current lower gold price environment to, first of all, buy projects that are available, which wouldn't otherwise have been available in a rising gold price environment, and secondly, bring in projects that are lower cost. So basically, we're trying to upgrade our assets. For example, the Ana Paula project has projected cash costs of $486 per ounce. That's the type of project that's available under the current environment. You have to have a good operating team like we have in Mexico to take advantage of that. But these are the things you have to do when the markets and the prices are where they are right now. But overall, let's face it, it's not a real pleasure to be operating in a margin environment like this. You're constantly trying to find ways to improve your operations, to optimize. The real challenge is going to be if we continue in this environment much longer, we're not going to see the replacement of resources and reserves, and we're going to see a real squeeze in gold at some point as the reserves get depleted. So having a good pipeline of projects or building a mine is very important now because we might be able to time the cycle properly.
Sean, a quick comment?
Yeah, I think clearly a lower gold price, there are a number of situations that are struggling now. So a lower gold price would certainly put a lot more pressure, but there's no shortage of opportunities at this gold price. I think our project evaluation guys have never been busier. The challenge is to find something that can actually fit and you can actually add value to. And some stuff is cheap for good reason. And our project evaluation guys used a good example to our board recently where they said in the third quarter, this was the third quarter of last year, we had 68 inbounds. We looked at 18 in some detail. And we're not seeing companies throw in the towel. Those towels are flaming. They're flaming towels. And that's the way he described it. And 2 weeks ago, he used the same example. So certainly there'd be more pressure on some companies to act, but I don't think that that's going to make much difference because there's still a lot of pressure out there now for the junior companies. So you can only buy so many things. You can only manage so many things. So for us, it's just put those resources, let them do the work. And for our guys, they're not bonused on doing deals. They're bonused on the quality of the assessment. And what I always say to them, look, I never know when my phone's going to ring. If it rings, I'm going to phone you. And I don't want you walking down the hall with a one-pager. I want a 2-inch file, and I want a view on value and determine whether it makes sense for us. So the question is, you just need to be ready and have done your work ahead of time. But I would use the example of Osisko. If gold prices if they were a lot higher, there would never have been a bid for Osisko. You know, it was a combination of that company not having the opportunity to optimize when the bid came in, and the gold price was low, and the share was in the $5 range. So when you look at that, that was an asset that became available in a lower gold price environment. So you've got to be ready to move when you find things that can actually drive your business.
I agree. There's a lot of opportunities out there. It's just finding what fits within your organization and those values. I also agree that, you know, we're seeing deposits becoming more and more difficult. We're seeing people go into third world countries and how risky those can be from political pressures, nationalization of mines, things like that. So I think that people are going to start looking again at the U.S. We hope that our efforts in the southeastern U.S. will make people take a close look there. The benefit for us in the low gold price environment is we know this area better than anybody, and it's an area that nobody's really operated in 25 years. So we want to take what we've done in that area and try to make, you know, a lot of headway. So for us, it's a benefit to be able to explore while the market is fairly quiet overall.
Thanks. Ladies and gentlemen, I don't want to encroach on Martin's time, because I want to give him a good chance to talk on pleasant dinner conversation, according to his slides here. I'd like to thank our panelists, and I'd particularly like to thank Patrick and Andre Michaels for not only arranging the panel discussion here, but for also, once again, arranging such a splendid evening. It's becoming one of the features of the year. Can I ask you to just thank our panelists, Bruce Braganola, Sean Boyd, and Diane Garrett. Thank you very much.
Thank you.
Thank you.